What happens when a company reshapes its operations or finances? It's called corporate restructuring, a critical strategy for unlocking shareholder value and ensuring long-term growth. Let's break it down. Welcome back to Finance Ratios. Today we're tackling corporate restructuring. We'll cover spin-offs, carve-outs, divestitures, and debt restructuring, explaining why companies realign operations to create value. Let's get started. Corporate restructuring involves reorganizing a company's operations or finances to improve efficiency, increase value, or address financial distress. Think of it as hitting the reset button. Companies might sell off non-core assets or renegotiate debt to align with their goals. Let's start with spin-offs, carve-outs, and divestitures. They all involve separating parts of a business, but differ in execution. A spin-off creates a new independent entity by distributing shares to existing shareholders. This allows the subsidiary to operate independently. For example, a tech company might spin off its cloud services division. In a carve-out, the parent sells a minority stake in its subsidiary through an IPO. The subsidiary remains under the parent's control. A manufacturing firm might carve out its robotics division to raise funds. A divestiture involves selling part of the company to a third party. This generates cash and refocuses the company's strategy. For instance, a retail chain might sell underperforming stores to focus on e-commerce. Why do companies restructure? To create shareholder value. Focus on core businesses, improve profitability and efficiency, unlock hidden value, attract new investors. Understanding these strategies is key. Shareholders benefit when companies streamline operations. Next, let's talk about debt restructuring, a strategy to manage liabilities and improve cash flow. In a debt-for-equity swap, creditors exchange debt for ownership stakes. This reduces debt and provides a fresh start. Companies might renegotiate loan terms or replace old debt with new debt at lower interest rates. To avoid bankruptcy, companies and creditors might agree on new terms privately. These strategies can position companies for growth by freeing up capital. Corporate restructuring realigns and creates value. Key strategies include spin-offs, creating new companies, carve-outs, selling minority stakes, divestitures, selling non-core assets, debt restructuring, swapping debt or renegotiating. These strategies refocus, improve efficiency, and maximize shareholder value. That's a wrap on corporate restructuring.